They're making billions, quietly. While most people obsess over stocks and bonds, a different kind of money game is exploding behind the scenes. It's called private credit, and in 2025, it's not just for the ultra-rich anymore. Everyday investors are starting to tap into it, chasing returns as high as 20% all, while the mainstream media barely mentions it. This shift didn't happen overnight. It began when traditional banks started pulling back. Rising interest rates, tighter regulations, they made banks cautious. But businesses still needed funding, so a new breed of lender stepped in. And with that, private credit began to soar. Now here's where it gets interesting. This isn't just some exotic finance trend. In 2024 alone, private credit-backed companies in the US supported nearly 2.5 million jobs, paid $87 billion in wages, and fueled $145 billion in GDP. That's real economic impact, not just financial engineering. And it's not happening through the stock market. There are no tickers here, no IPO buzz. These are direct loans to companies, structured, negotiated, and executed away from Wall Street's spotlight. And guess who's quietly getting in? Not just hedge funds. We're talking insurance giants and pension funds. In fact, companies like Prudential are moving hundreds of millions into private consumer loans through fintech platforms like Affirm. JP Morgan, they've already set aside $50 billion for private credit deals. These institutions aren't gambling. They see a clear opportunity, stable, predictable returns in an uncertain economy. And they're moving fast, because the window might not stay open forever. But it's not just institutions anymore. Thanks to new investment structures, private credit is slowly becoming accessible to high-net-worth individuals, and even advanced retail investors through specific funds. Think of it like real estate syndicates, but for lending. You pool your money into a fund, and that fund lends it out to middle-market businesses, real estate developers, or tech startups. In return, you get consistent income, often secured by collateral, a rarity in today's yield-starved market. Still, let's not pretend it's risk-free. Every investment carries trade-offs. Private credit lacks the transparency of public markets. You can't check a price on your phone. Liquidity? It's limited. Your money could be locked up for years. And the big one, we haven't truly seen how this market performs in a deep recession. Some deals are well-structured, backed by assets. Others, built on optimism. So doing your homework isn't optional. It's essential. But if you're tired of bonds barely beating inflation, if you're skeptical of overvalued stocks or just looking to diversify beyond the traditional 60-40 portfolio, private credit might just be your edge. It's growing fast. It's delivering real returns. And right now, it's flying under most people's radar, which, in investing, is exactly where opportunities are born.